All right, today we're cracking open a professional's trading plan for one of the biggest stocks on the planet, Microsoft. We're going to break down the whole thing, when to get in, when to get out, and most importantly, how to manage your risk like a pro. So let's just dive right in, shall we? We're going to start with the big question, the dilemma that a lot of investors are probably wrestling with when they look at Microsoft right now. I mean, look at that run. The stock is soaring, trading near its all-time highs. And that, of course, creates that powerful feeling of FOMO, the fear of missing out. But at the same time, who wants to be the person that buys at the absolute peak? So what does a disciplined professional approach actually look like here? Well, here's where it gets really interesting. The core recommendation from this entire analysis is to wait. Yep. Despite all the momentum, all the AI excitement, the final verdict is that patience is the smarter move. Okay, so if the answer is wait, then the obvious next question is, what in the world are we waiting for? Let's get into the nitty-gritty of what a smart entry really looks like. First things first, let's get our bearings. At the time of this analysis, this is where the stock was trading. This is our starting point, our baseline. And this is the sweet spot. This is the primary entry zone that the plan is targeting. Now that's roughly an 8 to 11% pullback from where it was. The goal isn't to perfectly time the bottom, but to buy into a position of strength after a bit of a healthy dip. And look, these numbers aren't just pulled out of thin air, right? This zone is carefully calculated. It lines up perfectly with where the stock found support during recent dips. It also brings the valuation, the PE multiple, back closer to its historical average. Plus, it corresponds to a key technical level, the 12-week moving average. And crucially, it builds in a little margin of safety. So we've got our ideal entry point. But what happens if the trade goes south? This next part, honestly, this is the most critical piece of any trading plan. You have to define your exit strategy before you even think about getting in. Now, before we go on, let's just do a super quick breakdown of a key term, the stop loss. The best way to think about it is like an automatic emergency brake for your investment. It's an order you set up ahead of time to automatically sell your shares if the price drops to a certain point, protecting you from much bigger losses. And for this specific Microsoft plan, the line in the sand is drawn right here at $455. So if you got in around that optimal price of $480, this stop loss caps your potential loss at just over 5%. See? It's all about defining your maximum acceptable risk before you put a single dollar to work. And again, you can just see the discipline here. This price isn't random. It's strategically placed just below a major historical support zone. A drop to this level would be a big red flag, suggesting that the original reason for the trade is no longer valid. It basically says, okay, something's changed, maybe the whole tech sector is selling off, and it's time to get out and protect our capital. Okay, we've planned for being wrong. Now for the fun part. What's the plan for being right? Let's look at the strategy for taking profits if this trade actually works out the way we hope. And this is just so smart. Instead of trying to sell everything at one perfect moment, which, let's be honest, is nearly impossible, this plan systematically takes profits off the table in stages. As the stock climbs and hits these predetermined price targets, you sell off a chunk of your position. You're locking in gains along the way. It's brilliant. So let's put all these pieces together, right? We've talked about the entry, the stop loss, and the profit-taking plan. Now let's see the entire game plan on a single screen. And there it is, the complete playbook laid out clear as day. What I love about this is how it outlines different scenarios, from a more conservative approach to a more aggressive one. And for each one, you have a precise, predetermined plan for your entry, your stop loss, and all three of your profit targets. This right here, this is what turns wishful thinking into a real strategy. All right, let's wrap this up with the final assessment. What are the key bullish signals that are pushing the stock higher, and what are the big bearish red flags that demand our caution? So here's the crucial conflict. On one hand, you've got these powerful bullish forces, a strong buy rating from institutions, the massive growth potential from AI, and positive targets from Wall Street analysts. But on the other hand, you've got some major red flags. The people who know the company best, the insiders, have been selling a lot of shares. And maybe even more telling, they haven't been buying any. And this quote from the professional analysis really just sums up the entire strategy perfectly. It's basically saying, look,
Even though the company is strong, the fact that its own executives aren't buying stock is too big a warning sign to just ignore. And that's exactly why being patient, waiting for that pullback, creates a much, much better risk to reward setup.
And that kind of leaves us with a final thought, doesn't it? This whole professional playbook is built on one core principle: discipline. It's a powerful reminder that sometimes the most profitable move you can make is to do nothing at all. Which makes you wonder about your own investing habits. What's harder for you?